The first investment appraisal technique we are going to talk about is accounting rate of return. Accounting rate of return is the only investment appraisal technique which is profits based. Means it utilizes the accounting profit from the financial statements to calculate IRR, ROCE, return on capital employed, as well. Another name we have studied about it, ROCE, return on capital employed. So basically, there is one formula with average investment that we calculate average annual profit of the project over the life of the project. What is the average annual profit? Number of total profit divided by number of years. That is called average profit. So average profit is equal to total profit of the project divided by number of years. And this is called average profit. And then average investment is calculated by this formula, that initial investment plus scrap value divided by 2. So, and once ARR is calculated, accounting rate of return, which is also called ROCE, we compare that what the company has decided a target ARR. Normally, board of directors of the company, they decide that, for example, if a new project is giving a certain percentage of IRR, then we will accept the project. Otherwise, we will reject that. For example, the board has decided 30% ARR. So if a project which is being evaluated has an ARR less than this, it will not be accepted. It will be rejected. Above that 30% threshold, that will be accepted by the business. It's another formula where ARR can also be calculated, that is equal to average annual profit, are taken like this, and then divided by initial investment. This is another formula which is quite acceptable. But remember, the preferred formula is this. So in exam, if the examiner is silent in the section C, we use this preferred formula. But if the question is tested in the section A or section B as OTQ, the examiner tells that which formula you will use based on initial investment or based on average investment. Now, so ARR, how it is calculated, right? For example, a project has the following profits. The profits, estimated profits are, for example, that is 300 million, 2,500 million, and 1,000 million. An initial investment in the project, we take example that is 4,000 and scrap value will be, that is 1,500. Now we need to calculate ARR. So average annual profit, we will calculate like this: 300 plus 2,500 plus 1,000 divided by 3. So it will be, if we calculate it, that is around around 1250. I assume it is 1250, right? And then average investment, if we take, we calculate that 4,000 initial investment plus scrap value divided by 2. It is 2750. So ARR can be calculated easily over here. The formula, average annual profit divided by average investment. So 1250 divided by 2750. So in this way, it is easy to calculate ARR. So 1250 divided by 2750. I'm doing it on a calculator. It is 45.4%. For example, 30% is the target ARR set by the board. So we will say that since ARR of the project is more than the target ARR 30%, it is around 15.4% higher than that. So accept the project. So accept the project. Now, a bit complex example. Sometime you are given cash flows of the project and you are told that calculate ARR. So in that case, we need to know the relationship between cash flows and profits, the relationship and difference. Because for ARR, we need to calculate profits from these cash flows. So remember that when we add back any non-cash expenditure to the when we deduct, yes, when we deduct the non-cash expenditure from the profit, from the cash flow, we get profits. We get profits. Simple is that because cash flows are the business, those net inflows and outflows from which non-cash expenditures have not been deducted. So when non-cash expense is deducted from it, we get profits. Similarly, for we can convert cash flow to the profit and profit to the cash flows like this. And what is the non-cash expenditure? Majority cases in the investment appraisal question, that is depreciation. For example, here they have given 7-year cash flows like this in front of you, and then they say initial investment is 800,000 and scrap value is this. So what is the non-cash expenditure here? Non-cash expense. We call depreciation here. Initially, this is the value 800 when the investment is started. At the end, scrap value is 100. Means initially the value was 800 and at the end of the project it will be only 100. So the difference is, it means it will be depreciated. The difference will be the depreciation. That is the 700 depreciation. Now what we will be doing, we will be calculating total cash flows. The sum of all these cash flows we can calculate. Yes, that will be, if you calculate the sum of these cash flows, that is 1750. Now we need profit. So profit, as per this formula, we will get 1750 minus 700. So that is equal to 1050 total profits of the 7 years. We have calculated. So now average annual profit we can calculate here. So average annual profit is 1050 divided by 7. That is 150. That is the average annual profit. Now we need to calculate, that is, we need to calculate average investment. They said initial cost, calculate for initial cost and average investment. So initial cost is 800. So ROCE based on initial cost, average annual profit divided by initial cost, and that will be the answer for it. 18.75%. ROCE based on the average investment. So average investment we need to calculate here. So average investment, we know that what is the formula? That is initial investment plus scrap value. So 800 plus 100 is the scrap value divided by 2. So that is equal to 450. So ARR using the average investment, B part. So 150 average annual profit is the same, and 450 that is equal to 33.33%. So here is the answer. ARR of the B part, ARR of the A part using initial investment and using average investment. Now, so I hope now we will compare it. If they have given a target rate, we can compare and make decision. Now, in exam, you will be required to calculate normally in one way. So even if they ask both ways, you can calculate now. You have learned it now. So advantages, it is simplicity, simple to calculate, and based on profits, accounting data which is readily available, accounting measure. But yes, ARR has some drawbacks. It does not consider time value of money. Time value of money. That when profits are occurring, at what time? Okay. Now, it does not consider total life of the project. Okay, because it says, okay, ARR is 18%. So how much is the life? They say two projects. One has 18% ARR, the other has 20%. They say accept with 20%. For example, this project is of 10 year. This project is of 5 year. So in the decision, it is not considering it. What is the life? Now, so yes, accounting policies, profits can be manipulated. Profits can be manipulated with the accounting data, estimations, accounting convention. You change depreciation, you change provisions, profits will be manipulated. And hence ARR can be changed. It ignores working capital outflows during the project. Of course, it ignores. It tells answer in percentages only. Percentage return. What is the exact total benefits? It does not talk about that. For example, you are going to invest in a project. How much total profits you will be getting? What is the wealth increasing of the shareholders due to a project? It does not talk about that. And then, yes, signal, no definite investment signal. So that ARR is actually, it helps us that initial screening devices, the target return of profit, but it is not the final verdict. Further, after this, we have to evaluate project further, okay, using the other techniques, then we accept that.